Thank you for joining us today for our Pengana Private Equity Trust webinar. My name is Melissa Raylander and I'm the Distribution Manager for Pengana based in Queensland. For anyone that is new to PE1, it is a custom designed portfolio of institutional quality private equity investments, which has been specifically designed for retail clients as it offers daily liquidity and a 4% yield. The underlying investments are managed by GCM Grosvenor. They have over 76 billion in assets under management and are one of the top caliber firms in managing custom private equity mandates. Today from GCM, I'm delighted to say that we have Fred Pollock and Corey Lopretti, who are both managing directors. Fred is the CIO of GCM and Corey is a portfolio manager for PE1. The webinar will run for around 20 minutes with plenty of time for Q&A. If any questions do come up during the presentation, please pop them in the question box and we'll endeavour to get to them at the end of your call. Fred will run through a bit of an overview of the private equity landscape and then Corey will do a deep dive into the PE1 portfolio. With that, over to you, Fred.
Thank you very much, Melissa, and good morning to everybody who could join us. So first, just a little bit of background on the PE1 Trust and sort of how it's managed. And then I'm going to talk a little bit about the markets, and I'm going to turn it over to Corey, who's going to spend time talking about some of the details of the portfolio. And then the two of us will field any questions that everyone has. So on slide 4, just as an overview on Trust, we really manage the portfolio with this being a basic building block of private equity. So if you looked across Grosvenor today, managed about $76 billion US, a little over $100 billion Aussie in terms of assets. Our average client is a sovereign wealth fund, an insurance company, a pension plan, etc. We deliver the exact same institutional quality experience to the PE1 Trust that we deliver to those clients. And so we built up a portfolio of 400 to 500 private equity companies on an underlying basis, very diversified by sector, by region, by geography, by style, and by type, with the idea that we would deliver market-beating private equity returns over a long period of time. I'm pleased to report since the portfolio launched in 2019 that the NAV has grown by a little over 11.1%. That's even in light of the fact that when we obviously started the vehicle, it was all in cash, and cash was yielding 0. So if you looked at the underlying return on invested assets, it's over 20% in private equity, assets on an underlying basis. And as Melissa mentioned, obviously it's been designed to be on market and provide liquidity and access to investors as they like to trade in the secondary market. The 3 styles of implementation you'll see here, we call them primaries, co-investment, secondaries. You'll probably hear us use this language throughout. Many of you are familiar with this. Primary funds simply mean a private equity fund, typically 10 or more underlying private equity investments working with a sponsor, drawn down over 5 years and invested for north of 10 years. A co-investment is a deal, meaning investing directly into a private equity enterprise. And then a secondary simply means that we're going into the market and buying either a fund or a deal from someone who had originated that asset, typically at a pretty significant discount, which can be very interesting. Not on the slide, but on the top right, you see in special situations. We also invest in private credit, meaning the credit portion of the capital structure associated with private equity transactions. If we could go to the next slide, Corey. GCM Grosvenor, Melissa and I both sort of talked about it. I won't belabor it. The firm's over 50 years old. We consider ourselves sort of experts in private market investing. Our private equity vertical is over 30 years old. There's north of 50 employees and work on the investment side of that enterprise. Most of our clients are institutional. The PE1 Trust is actually an exception in the sense that we're able to deliver that institutional experience on market, which we're obviously thrilled to do. If we go to slide 6, I want to talk a little bit about what's been happening in the markets and set the stage for sort of the macro. So if you go back to sort of late 2021, I like to think of it as Q4 of 2021, what you're going to see is we had a significant regime change in the marketplace. We had interest rates go from 0 for 13 years to 5%, over that period of time. It's caused a lot of different changes in the private equity landscape. If you think of the average private equity enterprise, it's about 50% equity, 50% debt. The 50% debt portion of that obviously had increased cost, and that needed to work through the system. But also the discount rate on the cash flows increased over that period of time. And so we'll spend a little bit of time talking about it. The economic ramifications that I think we don't know yet, meaning a lot of people have been predicting a consequent consumer slowdown and a recession for almost that entire period of time as rates have gone up. I think our house view is that 2024 will be a difficult economic environment in the U.S. and in Europe in particular. I don't know whether there'll technically be a recession or not. I don't think it's significant whether it is. I think we know it'll be a period of sort of slow growth and elevated risks during that period. And we've tried to position the portfolio in terms of defensive exposures as well as making sure that the underlying companies and sponsors are thoughtful about the way that they structure their capital and organize themselves to be able to survive and thrive in that type of an environment. The other bit I'll tell you is that, like all things, there's two sides to the coin, which is while it's bad for existing assets and you have increased funding costs and a higher discount rate, the go forward return on invested capital is far superior to what it was for the 13 years during which you had zero interest rate policy. So, the ability to invest in both credit as well as invest in the equity side, we're typically earning 5 to 7% more in each of those types of investments than we were in the prior period. And so I think in the long term, this type of environment is much better suited to be able to generate outsized returns in the private equity space over time. And so we've worked our way, I think, largely through the mathematical valuation effects of rates. We still have the economic consequences of that to go through next year and possibly the year after. And then the forward return environment, I think, is actually quite good. Corey, if we could go into slide 7. So I mentioned this a little bit, sort of why do we think that there's elevated risk? You'll see the growth is just being very challenged. And if you look through the probability of recession, just sort of consensus forecast, today it sits a little over 50%. I think if you looked at this as of this moment, it's probably closer to 65% in terms of market pricing. I think we'd agree with that, which I think is probably about a 2/3 chance of a contraction in economic activity. I think even the other third, though, is of slow economic activity. I don't think there's a very significant chance that 2024 is kind of a banner year for economic activity in the US or Europe, where most of our portfolio companies are held. And therefore, I think that sort of, I don't know if I'll call it pessimistic, but realistic idea that the economy is not that vibrant and you need to be able to position yourselves appropriately for that. I think that's what we're trying to do. The next slide, 8, you'll see that the market maybe is a little more optimistic. So, equities and public markets, I think, are a little bit of a confusing story for investors today. And I spend a lot of time talking to institutional clients on this basis too. If you looked at the equal weight index of, say, the S&P 500, the MSCI World, what you'd see is it's down on the year. It's down for 2023. If you look at the actual S&P 500, it's up almost 14%. And you try and reconcile the difference between those two things, it is essentially 7 or 8 securities. It's 7 or 8 stocks. They're very large cap technology stocks like NVIDIA, Meta, Google, Microsoft, etc. They've really been benefited from the market's belief that AI and generative AI are going to be significant value changers for those companies over a long period of time. Uncertain exactly how that translates through to their cash flow and profitability, but there's a sense that there's an opportunity for them that wasn't priced in before. Those securities have rallied, typically 70 to 90% year to date. They're very big market caps, $1 trillion plus market caps. So they had a significant impact on me. But the overall market is pretty sanguine, actually. I'll tell you, the other thing that sort of happened is people are trying to figure out how to price rates. And you'll see, you've had increased rates on the 10-year, the 20-year, the 30-year, kind of across the board over the last period. The last few days, you've had a bit of a retracement in those rates. That's mostly around geopolitical risk, I think. And a sense that maybe the Fed won't continue to raise rates, maybe Europe won't continue to raise rates as a consequence of some of those geopolitical risks. We don't really know. We're just building our portfolios to be defensive in line with what we think will be difficult economic conditions and rates that are at least higher for longer, regardless of whether they start to decline a little bit, after the fact. If we go on to slide 9, Corey. So the opposite story here is obviously, like I said, the two sides of the coin. It's a very attractive time to pursue and take advantage of those all-in yields, though. And so, every dollar that we're deploying in the credit space, and Corey will go through this a little bit more detail in a second, but if you go back 2 years, the trust had about 40% of its capital in cash when this regime change happened. Today, we have about 11% in cash. And the incremental investment of that sort of 29% of our assets has really gone to credit and private credit transactions, taking advantage of this yield change. And previously, we were unable to earn a satisfactory return, so we weren't allocated there. Now we are able to meet the sort of target allocations that we had for the overall trust. And in the second place are secondary transactions, meaning going into the marketplace and taking advantage of the fact that the yields have moved, the equity risk premium have moved on the transactions. And then we can also kind of intermediate inefficient, illiquid transactions and buy those types of things at a discount. Slide 10, to give you some quick sense, there's an increasing risk of a distress cycle. And by that, what do we mean by a distress cycle? We mean formal bankruptcies. We mean formal breakages of capital structures. The default rates, what you'll see on the side on the right here, they have a tendency to lag. The leverage loan market index is think of that as made up of all the first lien, second lien, tranche type instruments that are financing the average private equity or buyout enterprise. There's a significant amount of pickup in terms of default activity. It doesn't look like it because you sort of look at that and say, well, what does it really mean if it's less than 2%? A change from almost nothing to almost 2% that rapidly, and there's a continued change. We think will mean that there'll be more distress, more opportunity to take advantage of that for a distress cycle. And then on the left-hand side, we've tried to put here so people understand it. There's a kind of a wall of maturities that will very likely increase the amount of distress activity over the next couple of years. And so you'll see there in terms of high yield bonds and leverage loans in particular, there's some significant maturities in 2027 and 2028 in particular that the system is going to work through. And when those things get refinanced, they'll be at higher costs, lower leverage levels. There'll be a requirement for more equity. And in some cases, there'll be distress processes that we could take advantage of. I don't want to sound like a kind of craven investor or a vulture, but as a value-oriented shop, which Grosvenor definitely is, we like to take advantage of these process-oriented opportunities to infuse capital into good businesses. We want to look for ones where obviously it's a good company with a bad balance sheet, but we think we'll be pretty significant participants in that. And therefore, the trust, the PE1 trust, will be able to take advantage of this cycle, over the next couple of years as well. Slide 11, just to talk a little bit about leverage buyout activity. The number of deals, the number of realizations, meaning things bought and sold, is just down. If you went back a couple of years, 2021 and 2022 were abnormally large amounts of buying and selling. I think those were anomalous in terms of the amount of activity, particularly around COVID and post-COVID. We're not back to normal though. We're below normal right now in terms of the amount of buying and selling activity. Corey and I could both comment on this in the Q&A, but I think our suspicion is there's still a little bit of a difference of opinion between buyers and sellers. I think the buyers have largely gotten reconciled to the new conditions and the new state of the world with rates where they are and with values where they are. I think there are still some sellers living a little bit in a hopeful past. And, as those gaps collapse between buyer and seller expectations, I think you'll start to see more activity in the marketplace. I think you'll also see, as those capital structures get closer and closer to maturity, the incentive of transacting starts to go up for a lot of equity sponsors, even if it's not at valuations that they like. And so I think you'll start to see a pickup in activity, more turnover in the portfolio. And, we think that'll be a good thing actually for our investments. Slide 12, I'll touch on this really briefly. So, why have private equity valuations been resilient? So the first thing I say, they've not been totally resilient. If you looked across our portfolio, we have plenty of write-downs. There's some things that have been written down 75%. There's things that have been written down 10% and 15%. And that's over an 18 or 24 month period where, the cash flows typically of the enterprises are growing north of 10% a year or 15% a year during that period. So, if you go sideways, you really are taking the multiples down, obviously, because the value is coming down that way. And then in some cases, we've had explicit write-downs. But writ large, it's been an environment characterized by kind of treading water on private equity valuations. And if you looked at the valuation of the trust, the PE1 trust, the NAV really has kind of gone sideways over the last kind of 18 to 24 months. So, it stays in alignment with that. It's been buffeted a little bit by the Aussie dollar's decline, which we can talk about. And then we think we've taken appropriate action where needed to sort of mark down valuations and make sure that the NAV is robust. Slide 12, 13, just talking a little bit about opportunities for discipline. So I think I covered these writ large, which I think the real opportunity is there's a period of uncertainty. Rates are high, cost of capital is high. You have some forced sellers in the private equity landscape. We're trying to take advantage of that by deploying the money into credit, deploying the money into secondary transactions, and just be strong hands. I'm happy the way the trust was structured, which is it's structured in the same way that our typical institutional account is structured. It is a strong hands. The capital is there for the duration. There's no liquidity need within the portfolio. There's no need to go sell assets at the wrong time. And so, we really are able to be strong hands and buyers of assets during these periods. And I think that will be to the benefit of the trust and be to the benefit of all the investors derivatively in the trust, over the next decade, the fact that we were able to deploy capital during these periods of time instead of being, sellers over it. And then slide 14, before I turn it over to Corey, like I said, this is just a great environment to invest in credit. And so the 10% or so alternative credit allocation that we stated back in late 2018 and early 2019 when the trust was formed, we were at zero for a number of years. We're now edging our way up into the high single digits. And, we would hope to be able to get that allocation, closer to 10% over time. It's the idea that you can now yield kind of a 12 to 14% return in that portion of the capital structure with covenants, with reasonable loan to value ratios, with real robustness in the structures, we think is very attractive. I don't know how long it'll last, meaning, those environments have typically tightened after a period of time, meaning right now the risk reward is very attractive and maybe it's a little bit of a premium that's undeserved. Typically you get some tightening, but I don't think we're going back to the zero interest rate world where that was a 6 to 8% proposition. It's 12 to 14 now. And as long as it's sort of north of 12, we'll continue to allocate capital in the alternative credit space and try and hit our target allocation of 10%. I'm glad that we waited, meaning we didn't rush in to do that in an environment where it wasn't well suited. And I think the environment has really come our way in terms of this allocation. With that, I'm going to pause and I'm going to turn it over to Corey, starting on slide 15, to talk about the underlying portfolio and some of the allocations.
Good morning, everybody. So slide 15 provides us with a high-level overview of PE1's current portfolio allocations. PE1 is now fully committed, has exposure to some 90 funds and over 500 companies with investment years dating all the way back to 2003. We think we've successfully achieved the broad portfolio diversification that we were targeting when we launched PE1 and had a stated goal of reaching our steady state, fully invested, well-diversified portfolio within 4 years. At this point, we've committed more than $500 million to investments, nearly 2/3 of which has been funded, and we've already seen meaningful distributions from those investments. PE1's already received nearly $82 million in proceeds from the investments to date, and we have a number of additional realizations currently expected over the next 6 to 12 months. Drilling down into the portfolio a bit, we invested in 16 primary private equity funds, and the portfolio currently has exposure to 100 co-investments and directs and 26 secondary transactions that are themselves providing exposure to 85 funds and more than 260 different portfolio companies. Our secondary activity is providing the portfolio with significant backward vintage year diversification, which is an important portfolio diversifier and risk mitigation tool. The current portfolio mix, which is illustrated on the right-hand side of the slide, is generally in line with the targets we established when we launched PE1 back in April of 2019. The equity and co-investment and direct sleeve comprising the largest portion of the portfolio at 60%. The equity funds portion of the portfolio, which contains our primary and secondary fund investments, continues to grow as our primary fund managers deploy the capital we committed to them over their 3 to 5 year investment periods, and we execute on more secondary transactions. As Fred noted, we're also excited about the opportunities we are seeing in private credit and have already executed 10 senior credit investments that are really benefiting nicely from the rising rate environment we're in. Given the type of return we are seeing today in the credit market, we would expect, as Fred noted, to see that private credit allocation tick up to quickly to 5 and up to 10% over the next couple of years. And then finally, worth mentioning that overall performance continues to be strong. PE1's private markets investments are generating a net IRR of just over 22% and a net multiple on invested capital of 1.6x. So this next slide shows how the portfolio has changed over the last 12 months. We've continued to build out the portfolio, and as you can see on slide 16, the size of our equity co-investment and direct sleeve inched up to 60%, which is where I would expect it to peak, while the equity funds portion of the portfolio ticked upwards to 26%, which is a trend I would expect to continue as the primary funds we invested in continue to deploy capital and drive value in their portfolio companies, and as we continue to deploy the money committed to GSF3 into more secondaries, as well as to execute on secondaries out of our tactical sleeve. We've significantly enhanced the diversification within the portfolio over the last year. We added 16 new equity co-investments and directs, really targeting more defensive investments alongside cycle-tested managers. We completed 15 new secondaries, which collectively added 22 more underlying funds and more than 100 underlying companies. We executed 6 new credit investments. We're excited about that opportunity set. And we completed our first tactical investment in January of this year, and then actually completed 2 additional ones in the last few weeks, 1 secondary and 1 co-investment. So we've seen a nice ramp up in activity there. And then we added 2 primary fund investments alongside one of our top performing European managers. All of this activity creates additional diversification for the portfolio and should help provide nice downside risk mitigation for PE1 and its investors. One other item I would like to note is that our cash position has continued to decrease as the portfolio is ramped, and we're now sitting on just over 10% in cash. As you can see, that is a meaningful change from where we were at this time last year, and I'd expect that cash balance to decrease as we finish out this year and head into 2024, as our managers identify and execute on attractive opportunities they find in the current market environment. Slide 17 provides some more detailed exposure information on the entire PE1 portfolio across several metrics. From a sub-asset class perspective, you can see that more than half of the overall portfolio is comprised of leveraged buyout investments, with 2/3 of that buyout exposure in the mid-market. As a reminder, we focus on the mid-market for a variety of reasons, including less leverage is typically required for middle market deals, there's higher deal flow volume, more liquidity options, since middle market exits are typically made via sales to strategics or to larger private equity shops rather than via IPOs. And perhaps most importantly, middle market buyout returns have outperformed large buyouts over the long term by 300 to 400 basis points. The next largest exposure from a sub-asset class perspective is to growth equity, either directly or where possible through investments that included structural elements designed to enhance the performance profile. These elements typically include a component of downside protection through the use of things like preferred equity and liquidation preferences. We've been focused on these structured securities within our equity co-investment and direct sleeve and have recently seen a number of really interesting opportunities. One other thing I will note regarding sub-asset class exposure is that you do not see venture capital. This is because VC allocations are not a part of the PE1 strategy. Geographically, the fund is 80% invested in North America and has some more limited allocations to Europe and Asia. This too is generally in line with our targets, though we can see the European exposure inching up a little bit if and when the market and geopolitical conditions in the regions improve. Also, given what is currently happening in the Middle East, I thought it was worth mentioning that PE1 has virtually no exposure to investments in the Middle East. Just one small company held through a fund we purchased in a secondary transaction. And from an industry perspective, the portfolio is quite diversified, with IT making up the largest portion at 20%, and several other industries, including healthcare, industrials, and financials, each comprising over 10% of the portfolio. All told, we are highly diversified by sector. So as I've done in the past, I'm going to use slide 18 to talk about the different sleeves and provide an update on performance and some of our recent activity in the portfolio. Just as a reminder, there are two different tools we're currently using to execute equity co-investments and directs for the PE1 portfolio: our multi-asset class, or MAC funds, and our co-investment opportunities funds. PE1 today has 187 million in commitments to our multi-asset class strategy, which employs an entirely opportunistic approach that allows us to be quite tactical in markets like today that are volatile or uncertain. MAC2 is fully invested, generated a diversified return stream across individual investments, asset classes, and sectors. The broad diversification within the portfolio has helped the fund to generate a very nice 1.7 times net multiple and a 16% net IRR to PE1 through the end of August. The fund has already returned 10% of invested capital, and we expect realizations to ramp meaningfully in 2024. One of those realizations will likely be the online grocery delivery platform Instacart. Due in part to the strong financial profile of the business, Instacart went public in mid-September. The company, which only comprises around 2% of PE1's private markets investment NAV, listed at $30 US a share, implied a valuation of $10 billion. Given the challenging equity market for tech and growth companies that has persisted for the last 18 months, market sentiment to the listing has been somewhat lukewarm. That said, the company is a cash-flowing, profitable business with a very strong balance sheet that includes quite a bit of cash and very little debt. We believe there's a good chance that growth will re-accelerate and that the multiple will increase in line with peers like DoorDash, and we're looking forward to seeing where it is trading when our lockup period ends next spring. Another investment we can see potentially having an IPO next year is Lineage Logistics. Lineage continues to beat budget by winning new business, managing pricing to protect their margins, and adding minimum volume guarantees to their contracts. It's a good defensive asset that should be resilient if we have any macroeconomic stress, given that food consumption is basically immune from the economic cycle. At 4.3% of NAV, Lineage is currently the largest position in the PE1 portfolio, so a realization would produce a material amount of proceeds to PE1. Overall, we believe the MAC2 portfolio remains strong, and it's well on its way to exceeding its performance targets, which were a 1.8 to 2x net multiple and a mid to high net teens IRR when all is said and done. Turning now to MAC3, which also has Lineage in the portfolio, that fund has invested over $1.2 billion in 23 investments. Fund at this point is about 2/3 of the way through its investment period and is off to a strong start, generating a 16% net IRR and a 1.22x net multiple to PE1. There are a number of early winners that are driving the good early performance, including SpaceX. That company's satellite internet service, Starlink, continues to gain customers at a high rate, and the company is free cash flow positive. The success of the Starlink business has helped the company complete several subsequent equity financing rounds at higher valuations from our original secondary purchase, which was at a discount to NAV. Another one is a company called Circle, which is a producer of specialty reusable water bottles that have proprietary disposable flavor cartridges. The company allows customers to add a variety of flavors combined with things like vitamins, caffeine, or other nutritional elements to their water. Our investment in Circle is in a senior preferred structured security that includes an attractive minimum return as well as a put right back to the company in year 5, all of which provides meaningful downside protection with upside optionality. Revenue growth and EBITDA have significantly exceeded our underwriting, and the company is currently in market for a new financing round at more than 3 times our equity conversion value. PE1 also has a $53 million commitment to our co-investment opportunities fund, GCF2, which targets middle market buyout co-investments in market-leading companies that have pricing power. The portfolio currently includes 18 investments, and it's well diversified by industry, geography, vintage, and sponsor. We've already had 5 full realizations within that portfolio. They've generated 2.5 times return to the fund. The fund has also had 4 partial realizations to date. Taken together, those realizations have already returned 2/3 of investors' capital. The remaining investments in the GCF2 portfolio are performing quite well, with no investment marked below 1.2 times cost, and 8 of the remaining 18 investments marked above a 2x. All of this is helping to drive a healthy 30% IRR and a 2 times net return to PE1. GCF2 is first quartile across all metrics when compared to other buyout funds from the same vintages. One of the investments that continues to perform well in that portfolio is Gamebell Technology, which provides technology solutions that are essential to the administration of health programs throughout the U.S. Since our investment in October of 2020, both revenue and EBITDA have increased substantially. And in 2023 alone, revenue and EBITDA have both outperformed 2022 by more than 10%, primarily driven by volume increases, yield improvement, and identified cost savings initiatives. All of this strong performance has resulted in the investment being marked above a 2.5x. Another investment, which we did touch on during our last webinar, is Advisor Group, which is one of the largest networks of independent wealth management firms in the U.S. That company provides financial advisors with things like technology support, securities processing, regulatory and compliance support. LTM pro forma EBITDA is up more than 60% from 2022, primarily driven by a couple of highly accretive acquisitions completed at the end of last year, as well as incremental cash sweep revenue resulting from all of the Fed rate increases. Pro forma EBITDA has tripled since our entry, and the investment is currently marked well above a 3x. Companies exploring some partial liquidity options that could return multiples on our money while still retaining a meaningful stake in the business. P1 has also invested $22 million in the next generation of our co-investment fund, GCF3. That fund has already made 7 investments alongside 6 different sponsors in 5 different sectors. Although it is very early in the investment period, we are pleased with the level of diversification within the fund and the quality of the assets. The equity fund sleeve is comprised of PE1 secondary transactions and primary fund investments. PE1 has committed $120 million to 8 secondaries. $65 million was committed to GSF3, which is an implementation tool that provides investors with a single point of entry to a portfolio of secondaries. That fund has now closed on 28 transactions, 8 of which were executed this year. The mix of traditional LP secondaries and GP-led deals continues to be good, with half of the deals closed in 2023 being LP deals and half being GP-led deals. There are now 11 LP deals in the portfolio, 80% of which were executed in the last 18 months. And on average, they were purchased at attractive double-digit discounts to NAV. GSF3 is already performing nicely, generating more than a 20% net IRR to PE1. So to give you a flavor for the types of deals we're doing, one of the deals we recently did involved the purchase of interest in 3 middle market buyout funds and 1 credit fund, all of which were focused on the healthcare sector. These funds, which were purchased at an average discount of just over 15%, provided us with exposure to 40 different portfolio companies that are well diversified by remaining value and includes a number of companies that have the potential to be realized in the next 6 to 12 months. And turning to a GP-led deal, we participated in the acquisition of the common equity of a company called New Era Cap last year through a continuation vehicle sponsored by Acon. New Era is the leading authority for authentic licensed headwear in the world, has long-term relationships with the largest sports league in North America. Acon was actually able to secure the deal at a significant discount to comparable public companies in precedent transactions. Since our investment last year, the company has achieved significant revenue and EBITDA growth. The company just completed a dividend recap that returned 30% of our invested capital. The investment is already marked at a 2x with strong upside potential. Outside of GSF3, we've committed $55 million to 7 standalone secondaries. These secondaries have provided PE1 with significant vintage year diversification, with funds ranging from 2003 to 2019 and early net returns of 59% and 1.8 times multiple. This is still being driven largely by the strong returns generated by Project Rambler, which involved 35 funds that were purchased at a 44% discount. That investment is generating more than a 2.1 times net return to PE1 to date and has already distributed 125% of the capital PE1 invested in the deal. Within our PE primary sleeve, we've made commitments of over 95 million to 16 primary private equity funds, which includes 12 middle market buyout funds, 2 growth funds, and 2 special situations funds from 5 different vintage years. While still quite early for most of the primaries, with the primaries we've committed to still having just under 50% of their capital to deploy in a market that we do think will create a pretty rich opportunity set, we are pleased with the early returns, with the fund generating an 18% net IRR and a 1.3 times net multiple to PE1. It is worth mentioning that value distressed investors like HIG, Winchurch, and Peak Rock, all of which are in the portfolio, should find great opportunities in the current market. All of these funds focus on operationally intensive investments in undermanaged and stressed or distressed companies, as well as opportunities that are characterized by things like complex business models or operations. While all 3 of those managers are performing very well to date, we believe a challenging market like we are experiencing today positions them to truly outperform. Since we launched our private credit strategy last year, we focused on investing with high-quality sponsors and cash-flowing defensive businesses. We're also active in structured securities, but been pretty patient on more the stressed, distressed, and event-driven opportunities. As I mentioned earlier, we've already executed 10 investments in this sleeve of the portfolio. We've had 2 realizations at mid-teens returns, and the portfolio's investments are collectively generating a pretty attractive 11.5% estimated current yield. Finally, we've committed 13 million to 2 secondary transactions and 1 co-investment out of our tactical sleeve. The latest transaction includes the secondary purchase of an interest in a buyout fund focused on B2B investments in Western Europe. It's just entering the harvest period, so a really attractive entry point, as well as a co-investment in the 5th largest global insurance provider. Slide 19 now lays out the 10 largest positions of the portfolio, and it looks quite similar to what we presented at our last webinar, with Advisor Group being the only newcomer. They replaced Thrive, which is our veterinary clinic consolidator. Thrive actually dropped to number 17 on the list, due in part to some headwinds caused by both supply chain cost inflation and labor dynamics. As we expected back in May, the valuation was reduced to 1.5 times costs, which is still where it's marked today. TSG, the sponsor we co-invested with on that investment, has started a number of initiatives to help drive profitability, including hiring a new CEO and COO, optimizing staffing and scheduling, increasing pricing in all non-exam services, and renegotiating supplier contracts. Now, I've already talked about several of the companies on this page, but I will quickly touch on a few more of them before moving on. I talked about the first 3. The next one is digital freight broker, Uber Freight. They have now fully integrated Transplace, which was the number 3 player in the digital freight broker space that they acquired nearly 2 years ago, and they've taken steps to lower their cost base. The benefit of that integration and the cost-saving initiatives have been partially offset by challenging macro conditions and persistent freight supply that has run in excess of demand. Companies remain focused on capturing market share during this challenging environment for all industry participants in that part of the market, and has taken steps to further reduce cost structure. Company is doing well, though, currently valued at a 1.4 times multiple. One other company I'll mention is Bolt. They're a leading ride-sharing provider in Europe and Africa. They've seen excellent growth, really driven by continued strength in rideshare and additional delivery services. Company continues to improve margins and profitability, though it was marked down in 2022 to reflect declines in public market comps that impacted many companies, particularly those in growth stage of development. That said, the investment is currently marked above a 2x, so it's still performing well. And then one last one, which we have talked about on prior webinars, is Inafis. It's a producer of phosphate and non-phosphate ingredients used across a variety of consumer goods and industrial products. LTM revenue has increased significantly since entry, and EBIT is up over 130%. Strong performance has been primarily driven by modest price increases and volume growth due to strong customer demand. The investment was marked above 4x as of 30 June. The company recently completed its 2nd dividend recap since we invested. It's brought total distributions to investors to 91% of capital invested. Given how strong performance has been, we believe there's a good chance the investment will be realized at some point in the next 6 to 9 months. So regardless of talking about individual positions here, I think the key takeaway is how diversified the portfolio is. This was our plan when we launched PE1, and we believe we've done a good job of achieving that goal to date. So now that the portfolio is fully invested, we thought it made sense to start including some benchmarking data with respect to the private markets investment portfolio. We are including 2 different benchmarks on this slide. One is an industry benchmark that is produced by an organization called Burgess, which is the most widely used industry benchmark in the PE world. Burgess Universe includes data on more than 10,000 private equity funds from different vintages, strategies, and geographies. Comparing PE1 to the applicable Burgess Index, PE1 is generating upper quartile returns to date. So we're feeling pretty good about how they're doing. We have also compared PE1's returns to the MSCI World Index using a PME. Under this methodology, you're essentially mimicking private equity cash flows by hypothetically buying and selling shares of the MSCI World Index at the same time the private equity funds call and distribute cash. As you can see by the chart, other than during the very early days of COVID, when we were just beginning to build out the portfolio, the private markets investments have outperformed the MSCI World Index. Since inception, that outperformance is between 1,100 and 1,200 basis points. So we're feeling pretty good about that as well. All of the activity within the portfolio has led to strong cumulative returns since inception. PE1 has generated annualized returns of just over 11% since inception as of 30 August, which is right in the middle of the target return that was established for the fund at launch. We feel pretty good about, particularly given the challenging market conditions we've had both during the pandemic and over the course of the last 12 to 18 months. After seeing NAV decline a bit along with the broader markets in the second half of last year, it's rebounded nicely and we're now at an all-time high. We also think, and Fred mentioned this before, that the performance to date is made even more impressive by the fact that we were still ramping in the portfolio after the last couple of years, which means that the actual PE returns are well in excess of the returns reflected here. And then finally, with a little more than a third of the capital we've invested still to be funded, we do believe PE1's managers are well positioned to take advantage of the current market environment, which we think should yield a number of highly attractive opportunities for PE1 across both private equity and private credit. Within the buyout side of things, we believe that many small and medium-sized companies will benefit from opportunities for consolidation and even possibly for restructuring in the current market. We also believe we'll see an acceleration in corporate carve-outs given the current economic climate as businesses look to generate additional liquidity and shed units that they've been less successful with. We've actually seen a number of these transactions over the last 12 months and have been able to execute on a few of them at very attractive pricing. Now, although we don't try to time the market in private equity, we do believe special situations funds, particularly credit funds, and those that make distressed for control investments will benefit in the current market. As Fred mentioned earlier, this is some of the best credit investing environment we've seen since the GFC. Additionally, the rising rate environment and potentially slower economic growth should result in increased restructuring and turnaround opportunities. A number of PE1's partners are cycle-tested value investors that we believe are well positioned to benefit. And then finally, we're seeing record secondary volume in the market, which is being driven by the rapid growth of the GP-led market and a return of businesses on the GP-led side. And I'll stop here and turn it back to Pengana.
Thank you, Corey and Fred. We have had a few questions that have come through. Corey, you partly addressed this, but could you break down the fund's performance by individual investments and sectors, and also comment on how you manage underperforming assets?
Sure. Well, we're very heavily diversified by sectors, and since none of them are overall having a huge component of the overall portfolio, all of them are sort of contributing in different ways to the overall mix of that are in there. I would say that if you were to look at least at a sub-asset class level of the growth equity over the course of the last year, those investments have probably performed a little more poorly as they've been marking market and looking to public market comps. However, at the end of the day, that is still a very small portion of our overall portfolio. And where we have done more of our growth investing, which has happened within our max sleeve, we've gone out of the way to try to structure those with some of the downside protection that I referenced earlier, that mitigates some of the risk that you would have had of going directly into the equity of those investments. And then to your other question about managing risk, we do really seek to mitigate risk through that broad portfolio diversification. Though we do try to do without diluting the risk-adjusted return of the portfolio. So we seek to make sure that we're diversified across vintage year, since market conditions in any year can greatly impact the success of a fund from a particular vintage year. That's why we now have exposure to funds from 2003 to 2023. So we're very broadly diversified from that perspective. We do seek to try to make sure we have appropriate geographic diversification. We invest across multiple strategies, which is why you see exposure to anything from credit to growth to buyout. And to other special situations. And we want to make sure that we include an appropriate mix of different sponsors, because it's important to make sure that overexposure to a single manager can have pretty bad effects if the manager's targeted strategy runs into problem.
Thank you. And a question for you, Fred. I know that despite the current volatility in markets, you're quite optimistic about future returns. Is there a particular time in history or vintage that you feel that this environment reminds you of?
Well, I mean, it's interesting, right? I think rates just went back to normal. So I think the first thing I sort of tell people is it's not as bad as everyone thinks it is. Everyone sort of thinks like, oh, rates are 5%, rates are so high. I think that's largely a function of people having a fairly short market experience, meaning, and Corey and I laugh because it's like we have a lot of 25-year-old and 30-year-old analysts at Grosvenor who, their entire professional career rates were zero. And whenever anything got tough, there was a quantitative easing type action that would sort of support value. So I actually think we're just back to normal. I think rates are back to normal. I think you're back to a normal environment where good quality sponsors have to do things at companies to generate value and grow the cash flows instead of the idea that the cash flows just get richer valued on exit, right? I think that's kind of like the environment we're in. I think that is not that different than kind of the early 2000s, most of the 90s. The 80s were characterized by declining interest rates and kind of easy money. Obviously, kind of coming out of 2008 and 2009, you had the same period for a few years there where rates went from, kind of 5 to 0. But those were the anomalous periods. And this is actually just quite normal. And I think the idea of generating kind of high teens type returns from a high quality diversified private equity portfolio, also very normal. It was more of a zero interest rate world that was an anomaly and a little bit more challenging. In terms of like broader, like what's the historical analog? I'm not sure yet. Yeah, if that makes sense. Like, I mean, there's parts of this that feel like the early 70s. I hope that's not right because that was a bad period for investment writ large, from the late 70s. But we don't know yet, actually, kind of like what the historical analog is. But I think this isn't that different than just a normal investing cycle.
Thank you. I know that you aligned the sectors with the broad-based sectors in terms of technology weightings. Can you sort of talk through what technology means in the private equity sense and how it is sort of distinguished from those large cap names that we see?
Yeah, maybe do you want me to take that one, Corey? I think so. Like, what's going on? There's kind of two technologies I think actually that are like fundamental and game changing. One are what are called GLP-1s, these are medications to help people lose weight. I think that's actually that we could spend a lot of time talking about, but I think this is a big deal actually. Like a lot of the unfunded liabilities in the US are all around health and healthcare, and they all have a relationship to people's kind of weight and caloric intake and health. And so then there's a lot of game changing ramifications. The other one, obviously, we all know about and hear about is generative AI. The thing that's flooding the market in terms of pricing right now are both of those things, both positive and negative. So you would see, kind of people call them the Magnificent Seven or the Magnificent Eight, depending on whether you include kind of these are NVIDIA, Microsoft, etc. They've gotten very, very significant multiple expansion, not cash flow growth. Meaning the cash flows haven't changed at all as a result of AI, but they've gotten very significant multiple expansion because people are excited about the prospects of AI. I'm also excited about the prospects of AI, but we are currently in what I like to call the consumptive phase of that technology, meaning people are using it just to like play around on the internet and have fun with ChatGPT and do things that aren't really changing anyone's lives in a productive way yet. But you could see a world in 5 years or 7 years where you do get a big productivity spike as a result of that as it kind of works away. So I'm not that I'm not excited about it. I think it's just hard to value, and the markets have already put in pretty significant increases in multiples and those things. And then the other one is exactly like sort of weight loss medications and what that means, both positive and negative. So there's a lot of consumer food companies and other things that are being negatively affected, meaning the multiples are coming down. There's a company in the US called Lamb Weston, which makes French fries. The multiple's down a lot, as a result of kind of those things working their way through. So I think just kind of pulls and takes from those technologies. My own personal view is there's always a new technology, whether it's like an airplane, whether it's a train, whether it's PCs, whether it's the internet. There's always something to talk about and drives growth kind of overall. These are the next wave of that. What we try and do in the portfolio is just make sure we're balanced around those risks, meaning we don't want to get disrupted by technology and not be benefiting, kind of in the normal way, nor do we try and take sort of like outsized risks that some technology is game changing, because you just never know. You could find out tomorrow that these weight loss drugs actually perform poorly on long-term health consequences and they get banned. Like anything could happen. So, we don't take a big weight. And so, our approach is probably it's like sort of the cowardly approach to technology, which is we're aware of it. We try and take advantage of it to grow value, but we don't want to have the portfolio have an upset event around any of these technologies either being particularly successful or particularly unsuccessful. But some of these, like AI, is prolific, and you couldn't sit down in a meeting with our management teams and not have a conversation with them about like what they think it'll do and productivity. And everyone knows, and it's sort of in every business at this point in terms of productivity enhancement. We're just a few years off of seeing the benefits of it in the cash flows.
Thank you. Corey, you mentioned LP and GP-led deals. Can you explain the difference and in what circumstances you're happy to participate in the GP-led variety?
Absolutely. So GP-led deals are actually, at least the way they're constituted today, are somewhat of a recent phenomena in the secondary space. And this is when a general partner has had an asset in its fund and is looking to create a liquidity event for its investors. Historically, what a sponsor would do in that scenario would be then to sell it to another sponsor. And a lot of these GPs have decided that they believe that there is great upside. They're looking at their trophy assets and don't want to pass that off to another sponsor. So what they're doing is creating a continuation vehicle that they are selling the investment to. And there's a lot of benefits to this, assuming the assets are the right one. One, the GPs are selling an investment that they've run and managed for 2, 3, 5, 6 years or so. So they know the asset really well. Their management teams are already in place. So unlike in a co-investment scenario where a new sponsor is coming in and they have to bring in their own management teams, do their assessments of the company, you don't have that situation. And so you're already a leg up there. And then two, you really want to make sure when you're looking at these deals, these sponsors are putting their money where their mouth is. In a lot of these deals, these sponsors will be rolling a significant amount, if not all, of the capital that they would get in the liquidation of the investment. It's really only their investors who will get the option to liquidate out. They're also often, something we look for is to make sure that they are investing a significant portion from, say, their next fund. We want to make sure that we're appropriately in line when they're investing in some of these companies. LP-led deals are what you would say is a traditional secondary. An LP selling a position they've held in their portfolio for some period of time. A variety of reasons they do that, and we're looking to do those typically with managers we know, so we can get some more detailed information on the portfolio to come up with an appropriate discount. And it's that whatever that discount is really what's helping to drive part of the decision we're going to make.
And can you just define the difference between GPs and sponsors as well for our listeners?
Absolutely. GPs, managers, sponsors, all the same thing. My apologies for going back and forth between all of them, but it's the person who is running the private equity firm that we are investing with.
Cool. I have another question from the listeners. Do you find performance differs depending on the maturity of the underlying funds? And if so, are the newer strategies higher performing?
That's a complicated one. So meaning we have probably the world's largest small and emerging manager practice. Where we put capital to work, sort of helping people launch their funds. There's kind of two benefits of that. One, there is a little bit of outperformance from being small. People are hungrier. They haven't established their own wealth yet. And so this happens to be like a little bit more focused, a little bit more drive. And so you do see a little bit of outperformance in that class, but at smaller size, if that makes sense as investment. But the other real benefit is it provides you access later when they are bigger and they turn out to be good. And so, there are definitely funds where I would tell you there's some of, if you looked at the longitudinal study this is going to sound nerdy, but it's important in private equity, there's no relationship between prior fund returns and the next fund's returns. So you're not going to find, it's not so simple as saying like, well, they were good, so they'll stay good. That doesn't work in listed equities and it doesn't work in private equity either. It's too easy. You have to actually kind of rip apart what they're doing and figure out whether or not there's something that they're doing that will be systematic or programmatic or related to the people and the way that they kind of operate in their niche that will repeat itself into the next fund. When we figure out that happens, the problem is everybody knows it because everybody else figures it out. And then access is the difficult thing. And we normally have gotten that access because we provided them capital early on in that small and emerging manager program. And so, it's kind of like a complicated way of saying that it is not true that having been existing a long time in private equity makes you a better investor. In fact, in many cases, I can show you that returns degrade. But there are definitely ones where they do kind of create a better mousetrap. But once the mousetrap is obvious, you better have a relationship. Otherwise, you're not going to get your capital accepted by them to manage because everyone will want to invest. And we had to get there early to be able to do that. So I think our system overall kind of works well to sort of take advantage of it. But it's harder than it's like everything. It's harder than just sort of finding someone with great returns and giving them your money. It's too late. And in many cases, it won't keep happening.
In terms of, I know that you're exploring private credit, this sort of bunches together a few question, just sort of your thoughts on distress in the market, and maybe it might be worth touching on the mechanisms that a private company has versus just a public investment.
Sure. Me, Corey, you want me to take this one maybe? So
Sure.
how do we think about distress? So um, people have talked about a distress cycle for kind of 15 years, and you really haven't had one. What you really have had pockets of distress. For example, the energy complex had a period where oil was dislocated, and therefore you had some distress. You really had mostly bad companies that are broken, because who goes broke in a zero interest rate environment? You do pretty bad business, right? That's sort of like who you've had. And so it has made it feeling people are starting to get excited, and we're starting to get excited because you're starting to have a more broad-based phenomenon of default and distress because there's too much leverage or a bad balance sheet on what are otherwise good businesses. And so that's why we're kind of getting excited and organizing ourselves. It's a strategy that's a little bit gone out of favor, meaning the number of practitioners in the distress space is very small because they haven't had anything to do for a very long time, in terms of the interest rates. So, I'm pleased to tell you that Corey and I are happy. We have these relationships we built up over a long time. We kept those relationships alive during a period where the strategy was a little bit out of favor for the right reasons, and we're able to kind of utilize them. So, that's why we're kind of excited. The second question, which is, what can private companies do that public companies can't do? They can do all the same things. They're just more likely to do them. They have more focus. They're more intense. When we sit on the board, or the sponsors that we work with sit on the board of the company and have full control, the speed with which they take remedial action when the environment changes, like interest rates go up, or the economy softens, or there's a disruption in the supply chain because of COVID, they just move far more rapidly, and they take more deliberate action. You don't have the same number of kind of agency risks that you have in a public company. That's the real issue with being public is you just atomized control, atomized leadership, atomized governance. It just slows everything down. And they're less so, in my experience, what a private equity firm does after there's a change in the environment, public companies will also do. It's just years later, typically. And there's a real cost to that economically, being slow to change and being a little bit slow to be disciplined. So I think that's where a lot of the value comes in, meaning doing all the same things. It's just they do them quicker. They're quicker to, in some cases, it's unfortunate things like they have to lay off workers because, the economy is soft, that kind of thing. You'll just see a private equity enterprise move quicker to do it and with more kind of conviction.
Wonderful. We have gone over time, but I think we can fit in perhaps one more question because it's quite typical. It has been a very challenging market for IPOs. So, Corey, maybe can you talk through any upcoming realizations in the portfolio and what sort of proportion of the portfolio you might see that might realize in the near future versus long-term averages?
Yeah, we touched on a couple of them. Obviously, Instacart recently went public, as you've seen with a couple of the big companies that have gone through IPOs recently. The market reception has been somewhat lukewarm at best at this point, with most of them trading at or maybe slightly below sort of what their issuance price was. So, I think it's still going to be a little bit of time before that IPO market really starts to open back up again. Probably early next year is most likely where we expect it currently. Fortunately for us, a lot of our exits won't be through IPOs. Instacart, we'll obviously wait and see how that one comes out when we come out of our lockup early next year. I mentioned Lineage is likely to go public sometime in sometime in 2024. We have a number of strategic sales that we would expect. I mentioned Inifis before. We certainly can see a liquidity event around a couple of the investments in GCF. There's Gainwell I talked about before. Cotiviti is another one, all of which we could see being sold to a strategic potentially over the course of 2024.
Thank you. And I guess just in the last 30 seconds or so, Fred or Corey, is there anything specific that you'd like us to know or share?
No, I mean, my big picture message is that, since the trust was created back in kind of early 2019, we've dollar cost average. It's served us really well, meaning we built up a very diversified defensive portfolio over a long period of time in conjunction with Pengana. And, we had COVID, you had the post-COVID period with a significant amount of froth in the market. You have interest rate regime change during that period of time. And I think just sort of taking that deliberate building blocks approach to the portfolio has meant that we've constructed a nice portfolio that's been robust, held up well from a valuation perspective, although not impervious to those changes. and is set up well to kind of return and deliver a nice diversified private equity return in kind of the high teens in terms of NAV accretion on a go forward basis. So I feel like the thing we've been on these calls a lot. We tell people what we're going to do. I think what you'll see is we've done them. We've done exactly those things. And the two things that we were laggards to do, which was build up the alternative credit or private credit portion of the portfolio, and to build up the secondaries portion of the portfolio, this environment has allowed us to take care of those as well. So I feel like we've checked all the boxes in terms of what we said. And then, we are very grateful for everyone's support who has invested in the vehicle over this period of time. And, we hope that they get to enjoy the kind of fruits of that over the next couple of years when you see the evolution of the value over the next 5 or 10 years in the portfolio. I don't know, Corey, is there anything you wanted to add?
No, I think that's quite right. I think we've been very deliberate and patient in the way we've built out this portfolio, and it really will yield the types of returns we were targeting early on. We didn't try to get ahead of ourselves, and I think that will serve investors really well, and do greatly appreciate all the support we've got.
Well, thank you so much to Fred and Corey. That was a really fantastic update. And I think just to reiterate Fred and Corey's comments, we really are grateful from the support of our investor base. This has been recorded and there will be CPD points awarded. So they'll come out in the next few days. If you do have any questions, you can reach out to your local distribution manager. And with that, have an awesome day.